Right now, Australian families in these 10 suburbs are watching their monthly mortgage repayments exceed their entire take-home income, and the banks already know which postcodes are next. One of the 10 suburbs on this list is almost certainly within 30 minutes of where you live right now. I'm going to name all 10 suburbs in this video, starting immediately. No filler, no background, just the data. Craigieburn is already at the front of the line. Standard & Poor's data reported by Domain showed 3.10% of home loans in Craigieburn were in arrears by March 2025, making it the worst performing suburb in the country at that point. And by September 2025, Standard & Poor's was still naming postcode 3064 the national leader in arrears at 2.96%. That means roughly 1 in every 32 mortgages was already behind. The reason Craigieburn is so exposed is brutally simple. Too many buyers loaded up with maximum leverage in the 2021 to 2023 window on outer ring incomes that were never built to carry a $700,000 style loan for long. This is exactly the kind of postcode where a family stretched for a house and land package. Assumed rates would ease quickly and is now getting crushed by repayments, childcare, fuel, insurance, and the cost of a long commute all at once. Once listings start stacking up in suburbs like this, buyers do not see opportunity first. They see risk. That hollows out demand and pushes stressed owners into accepting lower prices just to get out. And if Craigieburn is under pressure, the next suburb on this list looks even more surprising. Because it is a regional city, most people still talk about like it is safe. Toowoomba already has 74% of homeowners experiencing mortgage stress, according to the analysis reported by realestate.com.au, making it one of the worst mortgage pressure markets in the country. That number shocks people because Toowoomba did not have the same national spotlight as Sydney or Melbourne during the boom. But that is exactly why it is dangerous. Buyers assumed a regional city meant lower risk, lower leverage, and a softer landing. Instead, what they got was a market where wages simply did not keep pace with the debt people took on when rates were at emergency lows. Toowoomba is especially exposed because a lot of buyers there entered late in the cycle thinking they were still buying affordable property. But affordable purchase prices do not protect you when your repayment-to-income ratio is already stretched and the local salary base is thinner than the capital cities. When 74% of homeowners are already under stress, you do not need a crash headline to know the suburb is vulnerable. You already have the warning light flashing on the dashboard. One more rate shock, one job loss, or one bad valuation, and a wave of forced selling becomes far more realistic. And if a regional city like Toowoomba is already this stressed, the next suburb tears up the national story entirely because it sits in a market the media has been calling bulletproof. Forestfield is where the Perth is untouchable story starts to break. Realestate.com.au reporting said nearly 5% of mortgages in Forestfield were in arrears, making it one of the standout pressure points in Western Australia. Nearly 5% is not a wobble. It is a serious pool of households already behind, in a state that most commentators still talk about as if rising prices solve every problem. They do not. Forestfield is vulnerable because it sits in that uncomfortable zone where buyers chased the Perth upswing, but the suburb still depends on household budgets that are far more fragile than the glossy state-level headlines suggest. When you buy into a rising market with a thin deposit and assume growth will bail you out, you are not building a buffer. You are borrowing against momentum. The moment that momentum slows, the debt is still there, the repayment is still there, and the exit gets harder. That is why this suburb matters so much. It proves a suburb can sit inside a strong state market and still be bleeding underneath. And if you thought Perth was supposed to be the safe side of the country, the next few suburbs are going to feel very close to home for a lot of Melbourne households. Cranbourne is already on the national arrears list with 1.74% of loans behind, according to Standard & Poor's data reported by realestate.com.au. That might sound lower than Craigieburn, but the danger in Cranbourne is the profile of the borrower. This is classic edge of capacity territory. Younger households, recent buyers, larger mortgages relative to income, and very little room left after groceries, petrol, council rates and school costs. That is what makes Cranbourne so fragile. It is not just the arrears number. It is the fact that the suburb is packed with households who bought late, borrowed hard, and have not had enough time to build meaningful equity before the rate cycle turned against them. Once equity is thin, people stop making strategic decisions and start making survival decisions. They refinance badly, they cut prices, they raid savings, and eventually some of them sell into a softer market. If Cranbourne feels exposed, Pakenham is sitting under the same pressure with the same kind of buyer. Pakenham is also sitting at 1.74% of loans in arrears, placing it among Melbourne's worst postcodes for mortgage strain. The trigger here is not mystery, and it is not bad luck. It is timing. Pakenham absorbed a huge share of buyers who purchased when money was cheap. Fixed loans looked harmless, and the assumption was that rates would normalize gently. That did not happen. Rates reset harder and faster than the local income base could absorb. The result is a suburb full of households who are not necessarily defaulting yet, but are already cutting back everywhere else just to hold on. That matters because mortgage stress is never only about the people who miss payments first. It is also about the people who stop upgrading, stop bidding, stop taking risk, and disappear from the buyer pool. That is how a suburb gets hollowed out before the official crash narrative even begins. And if Pakenham is already straining, Point Cook is where the numbers get even uglier. Point Cook is already running at 2.19% of loans in arrears, a materially worse figure than Cranbourne or Pakenham. This suburb is especially exposed because it combines elevated purchase prices with big household debt and a heavy stack of family expenses. Realestate.com.au Victorian Mortgage Stress Reporting singled Point Cook out as one of the areas most exposed to rate rises, precisely because so many owner-occupiers bought at elevated prices while juggling childcare, transport, education, and high ongoing household costs. In other words, Point Cook is not just a mortgage story, it is a cash flow story. When one more rate rise lands in a suburb like this, people do not feel it as an abstract policy change. They feel it as a grocery bill they cannot ignore, a car repayment that suddenly hurts, a credit card that starts carrying the month. That is when homeowners become distressed sellers without ever planning to be. And before we name the next 4 suburbs, you need to see the national pattern these places are sitting inside. Catality's May 7, 2026 report warned that Sydney had already fallen for 5 consecutive months and sat 1.0% below its November 2025 peak, while Melbourne was already 2.3% below its March 2022 peak. And Catality also warned that recent buyers, especially those using the government's 5% deposit scheme, were more exposed to negative equity as values soften. ANZ Research is forecasting Sydney to finish 2026 down 0.7% and Melbourne down 1.7%. That matters because when values soften at the same time, repayments stay high, low deposit buyers do not just lose comfort, they lose options. The suburbs most exposed are the ones where all 3 conditions are colliding at once, and the final 4 on this list are ground zero. Hoppers Crossing is already at 1.71% of loans in arrears, which puts it in the same national danger cluster as Cranbourne and Pakenham. The trigger here is the combination of older housing stock and newer, highly leveraged borrowing layered on top of limited wage growth. Realestate.com.au rate rise analysis pointed directly at Hoppers Crossing as a suburb where households are absorbing mortgage pressure alongside broader household expenses with very little spare capacity left. That is why suburbs like this can turn quickly. Buyers look at the suburb and see value. Banks look at the suburb and see stress. Vendors look at the suburb and see what their neighbour sold for 2 years ago. Those three views do not match, and when they do not match, prices get wiped faster than people expect. Hoppers Crossing is already under pressure, but the next suburb leaves the Melbourne belt and shows you how deep the stress map really runs. Campbelltown was reported by realestate.com.au as having nearly 100% of measured homeowners experiencing some form of mortgage stress, meaning spending was consistently eating into savings. Read that again, nearly 100%. That does not mean every household has missed a repayment. It means almost every household in that specific analysis was under enough pressure that the margin of safety had already been eroded. Campbelltown is the textbook case of a postcode where buyers chased home ownership at exactly the wrong point in the cycle. High prices relative to local incomes, maximum leverage, and a belief that Western Sydney would keep rising fast enough to outrun the debt. It did not. Once the market stops doing the heavy lifting, the household balance sheet has to do it instead. And in Campbelltown, that is a much tougher ask than people wanted to admit. This is where "I will just hold" becomes dangerous. Holding only works when your income can carry the holding cost. And that brings us to the pattern you need to recognize before the final two suburbs, because these last names are where the concentration of risk becomes almost impossible to ignore. Do you see the pattern connecting every suburb on this list? It is not bad luck, and it is not random. It is 3 specific conditions hitting the same postcode simultaneously. Purchases made at peak 2021 prices with maximum leverage, local income levels that were never capable of supporting those prices long-term, and a rate environment that has held higher for longer than any of those buyers were stress-tested for. Every suburb on this list has all 3. In Craigieburn, Cranbourne, Pakenham, Point Cook and Hoppers Crossing, the debt load is already obvious in the arrears data. In Toowoomba and Campbelltown, the stress is already broad enough to show up across huge shares of homeowners. In Forestfield, the myth of a bulletproof Perth market has already cracked at the postcode level. And the final 2 are where those 3 conditions are most dangerously concentrated. Berwick is one of the most alarming cases on the board because one widely cited 2025 analysis put nearly 100% of Berwick households in mortgage stress. That is extraordinary for a suburb many Australians still perceive as established, desirable, and fundamentally safe. But safety in property is never about reputation alone. It is about whether the buyers who set the local median can still carry the debt they took on. Berwick became a late-cycle borrower suburb in disguise. Families chasing bigger homes, bigger mortgages, bigger lifestyles, and assuming the suburb's image would protect the downside. It does not work like that. Once stress becomes that widespread, the market stops being driven by aspiration and starts being driven by exhaustion. People who thought they had years of flexibility suddenly realize they are 1 rate rise, 1 overtime cut, or 1 valuation shock away from being trapped. That is how a respected suburb starts bleeding like a fringe growth corridor. And if Berwick sounds alarming, the final suburb is next door, and somehow the numbers are still brutal. Narre Warren is where the concentration becomes impossible to dismiss. The 3805 postcode covering Narre Warren South and Fountain Gate had 2.79% of loans in arrears, according to Standard & Poor's data reported by realestate.com.au, making it the most troubled postcode in the nation in that data set. And another widely circulated 2025 analysis put 94.4% of 19,385 Narre Warren households in mortgage stress. Whether you look at arrears or broad household stress, the message is the same. This area is already under severe repayment pressure. The trigger here is concentration. Too many households bought too recently, too close to the top, with too little equity and too much dependence on rates coming down quickly. They already have the mortgage. They already have the higher living costs. They already have weaker resale conditions than they had in 2021. And if rates stay higher for longer, or if listings rise just as buyers retreat, this is exactly the kind of postcode where values can get wiped hard, because so many owners are forced to compete with each other at once. Now the question every viewer is asking is simple. Is my suburb on this list for a reason, or could mine be next? Here is the first thing to check. Start with mortgage stress itself. The Reserve Bank's basic threshold is households spending more than 30% of gross income on housing repayments and related costs. For your own postcode, do not wait until it crosses that line. Treat 35% as your danger zone and start paying close attention the moment local borrowers are clustering around it. Once a suburb gets stuck above that level, the households inside it lose flexibility fast. People stop renovating, stop upgrading, stop refinancing on favorable terms, and start selling for reasons they would never have accepted 2 years earlier. That is when the surface of the market still looks calm, but the underneath is already cracking. Second, watch days on market. If homes in your suburb are consistently taking more than 60 days to sell, that matters. A longer sales cycle tells you buyers are either pulling back or negotiating harder. That alone does not guarantee a crash, but when it appears together with rising stress, it is one of the cleanest early warnings you will ever get. The market always slows before it headlines. The sellers feel it first, then the agents, then the buyers, then the media. Third, watch auction clearance rates. If your local clearance rate is sitting below 55% for 3 straight weekends, that is not noise. That is a demand problem. It means too many vendors still believe yesterday's price, and not enough buyers are willing or able to meet it. Once that mismatch lingers, price expectations start to reset downward. That is how declines stop being a chart and start becoming a lived reality on your street. The second question is the one people usually ask too late. Should I sell before it gets worse? The honest answer is that it depends on what kind of suburb you own in, because not all losses are the same, and not all weakness is permanent. A structural collapse suburb is the one you should fear most. That is the suburb where the debt profile is bad, the local buyer depth is thin, and there is no powerful story pulling fresh demand back in. Craigieburn is the cleanest example on today's list. It has already been the worst mortgage arrears suburb in the country. It is loaded with recent high-leverage borrowers, and its resilience depends far too heavily on stretched households continuing to cope. If you are in a postcode like that and your buffer is gone, cutting losses early can be the rational move, not because the suburb has no future, but because your balance sheet may not survive waiting for that future. A cyclical correction suburb is different. That is a postcode where the debt pain is real, but the broader market beneath it is stronger. Forestfield is closer to that story. Yes, the arrears number is already ugly at nearly 5%, but it is sitting inside a Perth market that has still had broader support, and that means the suburb is not automatically condemned the way a weak outer-growth corridor can be. If the local economy holds and rates eventually ease, a suburb like that can stabilize. That does not make it comfortable. It just means the path out is different. Selling in a panic from a cyclical suburb can lock in damage that time might repair. Selling out of a structurally weak suburb can prevent much worse damage later. The hard part is being honest about which one you own. And that leads to the third question, which is the real payoff in this whole video. Where are the suburbs where mortgage stress is lower and values are more protected? If I were looking for resilience right now, I would not start with the loudest headlines. I would start with the suburbs where owner-occupier depth is strong, liquidity is healthy, and buyers are still behaving like they trust the postcode. Norwood in South Australia is one of those places. Realestate.com.au shows just 14 houses were available there in the past month. 117 sold over the past 12 months. And the median time on market for houses was only 21 days. That is what protection looks like. Homes move, stock stays tight, buyers are still willing to act. Domain's profile also shows house clearance rates in the mid-60s for key bedroom categories, which tells you Norwood still has genuine competitive demand rather than forced price discovery. In other words, this is not a suburb relying on investor hype to hold its value. It has real owner-occupier depth. Chermside is another suburb I would have on the resilience list, not because it is flashy, but because it sits in a Brisbane corridor with genuine infrastructure support and yield cover. Brisbane's rental vacancy rate has been recorded at just 0.8%, and that kind of rental scarcity creates a buffer that a lot of stressed eastern suburbs simply do not have. In a market where tenants are still fighting for stock, owners have more room to hold rather than dump. That matters. It does not make a suburb invincible, but it makes it far less likely to unravel the moment credit tightens. Manly in New South Wales is a different kind of protection story. This is not a yield suburb. It is a land-constrained, high-equity, owner-occupier heavy market, where people are not relying on thin deposits and perfect borrowing conditions to stay afloat. Even when Sydney softens, the most protected suburbs tend to be the ones where owners have large equity cushions and very little forced sale pressure. That is exactly the kind of suburb where price weakness is more likely to be cyclical than catastrophic. The key insight here is simple. The best protected postcodes are usually the ones with the fewest desperate sellers. Fremantle in Western Australia also stands out for a different reason. A 2026 market update put median sale time at 52 days for houses and 42 days for apartments. Those are not distressed numbers. They tell you stock is still moving in an orderly market. Fremantle also benefits from a diversified local economy, established community infrastructure, and a buyer pool that is not just speculators chasing a short-term story. That diversity matters because it gives the suburb more than one source of demand. When one group steps back, another can still support prices. If you want the simple version, here it is. The suburbs most protected from mortgage stress tend to share 4 traits: strong owner-occupier demand, tighter supply, higher equity, and a reason for buyers to want the suburb even when credit is expensive. The suburbs on today's danger list have the opposite profile. They are leveraged harder, they have thinner buffers, and too much of their demand story depended on cheap money lasting forever. It did not. That is why the smartest move you can make right now is not to panic. It is to classify your suburb correctly. If your postcode is showing rising arrears, longer selling times and weaker auction results, do not tell yourself that all suburbs behave the same. They do not. Some correct and recover. Some get hollowed out first and recover last. The difference is usually obvious in the numbers long before it is obvious in the headlines. Every Australian family that got trapped in a falling market over the last 30 years had one thing in common. They did not see it coming because nobody showed them the data before it was too late. You are seeing the data now. What you do with it is entirely up to you. Tell me below, is your suburb on this list? And if it is not, Drop your postcode and I will tell you exactly what the mortgage stress data says about your area. Disclaimer: this video presents analysis based on publicly available market data and trends as of mid-2026. Property markets are highly volatile, and past performance does not guarantee future results. The information provided is for educational and entertainment purposes only. All investment decisions should be made with professional financial advice. We are not licensed financial advisors. Always do your own research before making any real estate decisions.